Good afternoon. This is Sean Golding with Golding and Golding, here to discuss a little bit about how taxpayers from India can properly report their foreign accounts, assets, investments, mutual funds, ETFs, gifts, trusts, etc., etc. Each year at Golding and Golding, our international tax team works with hundreds of different clients from India, whether you're here on an F1 then moved to H1B, or you lived in the United States and now you move back, or you have parents overseas and they're the ones managing your account. It's very common to have accounts, assets, and investments in India. So let's walk through the basics, right? This is just a basic introduction. It doesn't account for all the nuances, right? You can't really cover that in a 10-minute spiel. So first, who's a U.S. person, right? U.S. citizens, of course, lawful permanent residents, green card holders. If you live overseas, you may be able to qualify for the exception to be treated as a non-resident alien, but we're not focused on that right now. We're assuming that it's a U.S. person for tax purposes. And then foreign nationals who meet the substantial presence test. So you come here in an F1 after 5 years, or you're on an H1B or an L1 transfer, an O1 or EB5 investment, B1, B2 travel, tourism type of visa. If you meet the substantial presence test, which is just a counting days test, then you're subject to U.S. tax on your worldwide income and you have to report your global assets. So let's talk about some of the common types, right? Bank accounts and FDs, whether it's a savings account, whether it's an NRO, NRE, 1 FD, 10 FDs, FDs associated with the account, FDs that are not, they're all reportable. Common situation, Joe or Jane is a U.S. person, they have assets in India, they may have an NRO and an NRE and a savings account, and then they've got 10 FDs that are interchangeable between different institutions, SBI, ICICI, just depending on what the interest rate is, or maybe they have parents back in India who are managing the accounts. That's all, the income's taxable, and it's all reportable. Income's taxable even if it's not distributed and it's just accumulated. But we're not really focused on tax here. We're just focused on the reporting. So all those assets are reportable, those asset classes. Typically the FBAR and the Form 8938. Form 8938 is for FATCA, the Foreign Account Tax Compliance Act. There's different components. But for tax filers, it's Form 8938 on their tax return. Stock, mutual funds, ETFs, things like that. So an account, for example, whether it's active or not, if it's a Demat or not, if it's got assets in it, stock and equities and funds, then it's reportable. Now, the complexity of the reporting will depend on what asset classes they have in there. For example, if it's just, let's say one person has a Demat with 30 different types of stocks, well, that's going to be an FBAR and an 8938. Let's say another person has an investment account with 20 stocks and 10 mutual funds. Well, that's going to get more complicated, right? Depending on what the value is, they may have to do FBAR, they may have to do 8938, they may have to do 8621 for the mutual funds and ETFs. In general, for something like the FBAR, you just report the full account. 8938, you report the full account. 8621, you parse out the funds. So the values will be important. Some people come to us and they go, I've got 40 different mutual funds in India, but none of them are in an account. Well, unfortunately, then you have to identify each one separately. Life insurance is very common, right? LIC or Prudential. Typically, the way it goes is if there's a surrender value or a cash value, normally there is, that's going to be reportable, not the ultimate payout value. Okay. There may be taxes on the. I got a lot of questions about 720. So if you pay foreign premiums, you may have to pay a 1% excise tax. There's also things like PPF and EPF, both Provident funds treated differently. Even though PPF is like a retirement supplement and it's not taxable typically during the growth, unfortunately from a U.S. tax perspective, it is taxable and the growth is generally taxable. EPF is an employee's provident fund. That's going to be through employment. There's a treaty with India. So the general position most experienced practitioners take is the growth is not taxable unless it's distributed. There's exceptions, exclusions, and limitations. People come to us all the time. They're like, oh, I was on expat form A or B, and they said you could do this whole, double secret strategy and avoid tax. You do what you want to do in order to try to get the result you want, but for the most part, if you're a U.S. person for tax purposes and you have these asset classes. They're going to be reportable and it's going to be taxable. You should be very cautious depending on what kind of strategies are out there and what people are trying to sell you on. If you live in a foreign country and you can qualify as a non-resident alien under the treaty, that's one thing. But if you live in the U.S. or you live in a non-treaty country, you've got these assets from India, you should be cautious if you're going to take any specific positions with an 8833, because that comes with its whole other set of headaches. What are some of the common types of forms you have to file? There's something called the FBAR and FATCA Form 8938. You'll see that all the time. Those are your basic forms. Typically, you just include the maximum value, the best value you could get under the circumstances. 8938 requires a little bit of additional reporting, but it's similar to the FBAR. Form 8621 starts to get a little more complicated depending on how many funds a person has, what type of PFICs they have, passive foreign investment companies. So if a taxpayer has mutual funds and they exceed certain threshold values, then some extensive reporting is required. There's some exceptions and exclusions and limitations, but not that many. If the taxpayer may have sold the funds, redeemed the funds, is receiving large dividends for the first time from a fund they've held for a while, then they may fall into excess distribution territory, and that gets infinitely more complicated with the reporting and the tax. So, when you've got things like funds, sometimes the FBAR and the 8938 is not going to cut it. There's other forms you have to file as well. If you've got a foreign entity, you do the 5471, depending if it's owned more than 50% by U.S. shareholders, then it may be a CFC, and you may have a lot of reporting. Something to consider. If you've got a family business, let's say, or you and your wife own a business together, and then you come to the U.S., now you're both U.S. persons, well, now it's a CFC. One very common issue with India is foreign gifts. When a taxpayer receives a gift, let's assume individuals, there's different thresholds, but for individuals, is if the U.S. person receives more than $100,000 from either one person or related parties in the same year. So it doesn't have to be one gift of more than $100,000. It could be 10 gifts of $11,000 for the year. Or it doesn't have to be from just one person if it's two related parties each give you $75,000. Well, neither gift is over $100,000, but combined it's $150,000, and now you have to report it. Foreign trusts also, you have to file 3520 and 3528. Foreign trusts are very common, especially for taxpayers who may be from India but lived in countries such as the UK and Australia before coming to the US or even Singapore, and they might have formed a trust or have trust-like quality investments. It's something to consider. If you're out of compliance, there are various programs you can use to get into compliance. But before I jump into that, what I've been noticing lately, what my team's been noticing lately, is there is a lot of fear-mongering attorneys out there making you believe that you are going to go to jail or prison if you don't immediately sign with that firm and pay a large amount of money or engage in an hourly fee representation. It is important to remember most of the time it is going to be non-willful. It is rarely going to be criminal unless there's other issues like money laundering and fraud and things like that that go along with the non-compliance. So if you're on an initial consultation, it's like one of these free ones, and they're trying to get you to panic. They get you in panic mode. You're afraid. Realize, think back in your life, has there ever been a time where you made a decision under pressure and you were really comfortable with the outcome? And what's even worse here is there shouldn't be any pressure, because most of the time the IRS does not move that fast. Most of the time it's non-willful and it's fixable. That's why the IRS created these programs. If you're willful, you do the voluntary disclosure program. Back in the day, even non-willful people did it because you can get the closing letter, but it doesn't work like that anymore. You have to certify that you're willful. So you'd only do that program if you're willful. And most people are not willful. If you're non-willful, there's various other programs available. There's the streamlined procedures, there's the delinquency procedures, and there's reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.